If you invest in the stock market, there is a very good chance that you might be making some mistakes that are costing you thousands. I have made some of these mistakes myself, so let's go through 5 mistakes you could be making and see how we can fix them to make our profits in the stock market even better. This first one is targeted mostly towards beginner dividend investors who go on to chase the high yields and don't look at any other fundamentals. A really high dividend yield can be seductive and can be great, but it's not the whole picture. You don't want to be buying and selling all the time trying to chase that yield. You want to be choosing companies that have a consistent high dividend, but over the long term, they have both price growth and dividend growth. Consistency in payouts is far more important than the dividend yield itself, even though you want a good dividend. And if you find a company where those dividends are growing over the long term, that means your yield is going to grow over the long term as well. Consistency will make you more money than chasing that high yield. And the easiest way you can check this is just go and have a look at the company's past dividend payouts and see how consistent they've been. And calculate the dividends over 1 year compared to the year before, Don't just look at the interim and the final dividend, which are often different. Mistake number 2 is always buying at market rather than putting limit orders in. Now, what are limit orders? You can put a limit order in anytime. The market doesn't have to be open, but you get to choose what price you're going to buy or sell at. And sometimes you can make an extra $200-$300 just by putting this limit order in. How do you do this effectively? If you're interested in either buying or selling and you have some time, you don't need to sell immediately or buy immediately, is to go and look at the 1 month graph and the 1 week graph. With the 30-day or the 1 month graph, you just want to see if the price is trending upwards or downwards, just to gauge what direction the stock is moving in. And the 1 week graph is to look at what's the highest price it's been over the last 5-7 days and what is the lowest it's been. That way you can choose a reasonable price that it's actually been within that week. And if it doesn't reach that price after a week or more, you can cancel it and you can put in a different price. This one works most when you have the patience to wait for a price, but also that you know the direction that it's moving in, so it's likely to hit that over the next 5 to 10 days. Just by putting those limit orders in rather than just buying at market price, you're probably going to make a little bit more profit than you would normally. But it's not always guaranteed, of course. Mistake number 3 is always thinking that the market is either moving up or down at any one time. Now, of course, the market is most exciting when it's going up or it's going down. That's when you can make the most money. But the majority of the time, the market is going sideways. It's not really doing that much. It might be going slightly up or slightly down, but it's not really moving a whole lot. Now, if you're a dividend investor, it's not as bad because you still are getting the dividends along the way. But if you're a growth or value investor, this can be a really frustrating time because you have to be patient and wait for those market movements. We always hear when the market's going up and it's rallying, and we always hear when the market's falling, but we very rarely hear when the market is not doing much at all and it's just moving sideways, which it's doing a lot of the time. So even though it might be slightly moving up and down, over the long term, if it's moving sideways, nobody's really making money except the dividend investors. So if the market is moving sideways, which it is a lot, the only thing you can really do is wait it out until there is some significant movement, or just keep cashing those dividend checks. Mistake number 4 is listening to buy or sell recommendations that you see online. If you're just blindly listening to other people, even if they have some sort of credibility in the market, if you haven't done your own research as well to make sure it is a company that you would want in your portfolio and a company that you would want to invest in, you could be making a huge mistake. Not every recommendation from an expert or even me is going to be right 100% of the time. Plus, if you have no idea whether a company is good or not and you're just going on the hype or the market noise, you could be making a really costly mistake. Definitely have a look and see if that company has been consistent in the past. And if it's a new fund or a company, be a little bit more cautious, especially if there's no track record yet. Even though it might look good on paper, I would pause. Don't try and jump in early. Sometimes it works out, sometimes it doesn't, but it's not guaranteed. Stay consistent and stick to the companies that make sense to you. And mistake number 5. Now, overconfidence in the market can lead to mistakes. We already know this, but underconfidence is also probably costing you a lot of money. A lot of people think investing is far more complicated than it needs to be. This is why just buying an index ETF is a good idea for somebody who doesn't want to do any research, because with one fund, you're just getting an instant diversified portfolio. But you probably do know more than you think, and you probably know how to choose a good company to invest in. All you really need to do is go and have a look at what it's done in the past. Now, of course, the past is no guarantee that the future of that company is going to be profitable, but it is a good indicator. Go and have a look at the graphs over the last 3, 5, 10 years. Go have a look at the dividends. What are they doing? Are they growing? Are they consistent? Stop thinking that you can't do this. This underconfidence, this fear of making the wrong decision or making a mistake in the market is stopping a lot of you making thousands of dollars and going on and building a great financial future. You probably are much better at this than you think that you are. You do not have to have an economics degree to start investing. All you need to do is keep it simple. Only spend the amount of money that you're comfortable spending, and once you get a little bit more confidence, then you can invest more. Believe in yourself. All of the mistakes I've mentioned in this video are very easy to fix. All it takes is a little bit of knowledge, a little bit of going and checking if the company or fund is profitable over the long term, maximizing when you're going to buy and sell, and just trusting yourself and believing in yourself. Investing can be super fun and it can be super profitable. Now, of course, there are many more mistakes that we might make in the market, but I think those are the ones that are really stopping people making the most money that they can in the market based on their experience level and the amount of money they want to invest. So I hope you've enjoyed this video. Have you made any mistakes in the past? I know I've made plenty. Let me know in the comments and I will see you in the next video. Bye.